despite the volatility around Trump's tariffs and, of course, the Middle East tensions between Iran and Israel, markets have actually fared pretty well this year. So bonds have delivered positive returns and equities have also delivered positive returns, albeit regional equity dispersion has been quite wide. And by that, I mean US equities have actually underperformed the rest of the world for the first time in many years.
The market thought and probably expected there to be some news on tariffs because Trump had talked about it for a long time, and indeed before his time as president, throughout his most of his life, he's advocated for tariffs. But the size and extent of the tariffs was far worse than what the market had thought, and that led to a pretty rapid drop in equity markets. The S&P 500, the main US index, had its third worst week in the last 10 years. And that obviously includes the COVID period. So equity markets saw a very sharp and very sudden drop on the news of those tariffs. Perhaps unusually and perhaps counter to expectations, the dollar also fell during that period, which I think was went against what most people thought would have happened to the dollar during such a period of market turmoil. Bond markets also didn't behave perhaps as people would have expected, although we did see some falls in US government bond yields initially. Subsequently, they actually started to rise, which is not always what you expect during risk-off periods for equity markets. And we think that increase in US government bond yields actually acted as a bit of a constraint on Donald Trump and the US administration. And after a few days, they announced the tariff pause. And that pause really led to a recovery in equity markets over subsequent weeks. I think the important thing about the pause is it demonstrated that there is a constraint on the US administration's actions. Although the administration didn't really respond to equity market moves, it did appear to respond to bond moves, because higher bond yields mean higher borrowing costs for the US government and also higher mortgages for US consumers. And we think that did prompt some kind of response from the administration. So there is a constraint on their actions. I think also the market took comfort from the fact that the administrations appear to be very willing to do deals. So essentially, although the tariffs were only on pause, it enabled the market to, if you like, discount the extremely negative scenarios that were very much a possibility in the early part of April and go on to make a full recovery throughout the rest of the second half. It's not unusual for the Middle East to have periodic episodes of tension. Although it doesn't say much for the market's humanity, the fact is typically those events do remain quite contained in the Middle East. The market, should we say, is quite used to those events happening. Obviously, there are flare-ups, and at times it looks like it's going to be worse. Market things like oil prices do tend to respond. You do tend to get some response from the market, but assuming that the actions in the Middle East remain fairly well contained to the Middle East, generally the market gets over those worries fairly quickly, and that's what we saw happen earlier this quarter.
So in sterling terms, US equities have actually delivered a negative return. When measured in other currencies, the return is positive. Now, over this period, we've seen sterling fall quite significantly against the dollar, around 7%. Over the same period, we've seen European equities return nearly 15%, again in sterling terms, and UK equities have returned nearly 10%. So the dollar has had a negative impact for sterling investors exposed to US equities. Now, there is obviously an opportunity to hedge US equity exposure. That is not our default position, and I think the bar for us to hedge US equity exposure is quite high, because typically, and certainly in bear market scenarios, so if you look back over time, and there have been big drawdowns in equities at various points, what you typically see is sterling weakens against the dollar. So that somewhat softens the blow of equity losses for sterling investors investing in US equities.
The fact that the US has got such a big weighting in global equity indices stresses the importance of diversification into other areas, and really the first half really showed the importance of that. So whilst US assets remain really important assets, the US dollar is the world reserve currency and there's no potential alternative on the horizon. US Treasuries are a critical market, and US equities have got many fine qualities. The events of the first half do show that international diversification is important, and we think maybe some of the shine has come off US exceptionalism over recent months. So we do like markets, equity markets and other geographies. Valuations are typically lower, albeit earnings growth isn't as positive. But we think in markets like Europe, we're starting to see some catalysts come through in terms of fiscal spending. Germany has announced huge fiscal packages recently to spend on defence and infrastructure. Other markets, remain challenged economically, but we're seeing some signs of improvement tentatively. The Chinese, the economy is still not great, but the authorities are taking some signs to stimulate, and we think when combined with lower valuations, that deserves an allocation as well. When we invest in overseas bond markets, we currency hedge those exposures. So that means changes in currencies don't impact the value of those bonds. And the reason for that is bonds being a relatively low risk asset, we don't want to add on currency risk to that. We don't want to turn that relatively low risk asset into a high risk asset. And that's important for low risk portfolios because it means that low risk portfolios can benefit from geographical diversification using global bond markets, but without taking currency risk. When we invest in overseas equity markets, we usually leave those unhedged. So we are exposed to currency movements in overseas equity markets. There are many reasons for that. I think fundamentally, for many companies, they are real living multinational entities. They sell in different countries, in different currencies. They manufacture in different currencies. So you're naturally exposed to those currency moves. I think also for sterling investors, sterling has got a strong historic tendency to go down during times of market weakness. And to sterling investors, that has typically kind of buffered equity downside during previous market crises.
I think if you were to look at headline returns, you'd think that not a great deal has happened. But as I've mentioned, we've had the tariff uncertainty and, of course, the subsequent volatility. The Trump administration have obviously walked a lot of those initial tariffs back, but there are ongoing negotiations, so that's not quite finished. That chapter isn't finished yet. We've also had the Middle East tensions, and we saw some volatility in oil prices. But as I said, headline returns have been pretty positive. They do mask the dispersion we've seen within equity markets. So US equities have underperformed European equity markets, and to a lesser degree, the UK equity market. But I think for all intents and purposes, it's been a pretty good year, and markets have withstood that volatility and bounced back pretty quickly. I think the outlook for the second half of the year is quite mixed as ever. So equities have bounced back from the tariff lows we saw in April. So US equities are back to all-time highs, and that's the case for other regional markets as well. I think the issue with US markets at the moment, or US equity markets, is that valuations are quite high. Now, we're underweight US equities for that reason. We've allocated more of our client money to European, UK and emerging market equities. But of course, in those regions, we need to see earnings growth coming through. And we've seen some downgrades to earnings growth in the UK. But we're comforted in Europe by the fact that fiscal spending is set to increase, certainly in Germany. And in the case of emerging markets, you've got the combination of Chinese stimulus helping support the domestic economy, but also a weaker dollar is typically quite positive for emerging market assets. The UK economy isn't in a great place. Certainly, Labour have discovered that there's no magic fix to the public finances. We saw quite recently they have had to sort of U-turn on the reform to welfare benefits and payments. Now, I think that makes the autumn budget very difficult. Certainly, we expect to see some tax rises. Now, that's going to weigh on growth a little bit further. And the OBR have said that the public finances are in a pretty dire state as well. So I think politicians are in a difficult spot. But of course, the UK economy doesn't necessarily translate to UK stock market performance. So the UK stock market is full of large international businesses who derive revenues from all over the world and operate all over the world, of course. So I think the outlook for the UK stock market is much better than the economy for those reasons. But also there's been a lot of M&A activity. So UK equities are quite cheap. We've seen private equity buyers come in and buy UK companies, very good UK companies at very low valuations, and certainly sterling weakness in recent years means that certainly for US companies buying UK assets is quite attractive, certainly from a currency perspective, but also back to valuations. US equities and companies are quite expensive, UK equities and companies are relatively cheap. So we've seen an influx of international buyers coming to the UK market to pick up pretty cheap assets, and we expect that to continue.
One change we have seen over recent quarters is a significant increase in the capital expenditure of many of the large US technology stocks. Historically, those companies have been quite capital light, i.e., to achieve growth and high profitability, they didn't really need to spend a great deal of money. But now there's something of an AI arms race going on where these companies are putting in very significant amounts of capital expenditure. There is a question mark over the extent to which they can make a profit on that capex. So while we think the future is still bright for these companies, clearly AI adoption is going to grow very strongly in society. It does perhaps raise a question mark, and I think the market will want reassurance as time goes by that those companies can earn a return on the increasing amounts of capital expenditure they're having to put into their AI assets.